Many people are asking a tough question right now. Is crypto mining dead? The simple answer is no, it is not. But making a profit has become much harder than it used to be. The days of plugging in a computer and printing money are long gone. Today, mining is a game of thin margins. It is a business where every single number matters. To succeed, or even just to survive, you must understand the cold, hard math behind it. This is not about hype or hope. It is about calculation. Let's look at a clear, realistic example for a beginner today. Imagine you bought a decent GPU mining rig last year for about $3,000. It is set up in your spare room. This machine is powerful, but it also consumes a lot of electricity. It pulls about 1,200 watts of power every hour it is running. If you leave it on 24 hours a day, that adds up quickly. That is 1.2 kilowatts multiplied by 24 hours, which equals 28.8 kilowatt hours per day. Over a 30-day month, your rig will consume approximately 864 kilowatt hours of electricity. At 15 cents per kilowatt hour, that is about $129.60 per month. If you earn roughly $80 in crypto, you are left with a loss of $49.60. The difficulty in making a profit from mining comes down to a simple squeeze. Costs are pushing up from one side, while revenue is being pressed down from the other. The biggest cost, by far, is energy. Electricity prices have risen significantly in many parts of the world. Global events have impacted the cost of natural gas and other fuels used to generate power. This directly translates to higher operational expenses for miners. What was profitable when power was cheap can quickly turn into a money-losing operation as grid prices increase. Every cent added to the kilowatt-hour rate eats directly into your margin. On the other side is the price of the coin you are mining. Rewards are paid in crypto. Value depends on market price when you sell. Major cryptocurrencies have traded well below their all-time highs. Lower prices mean the same coins are worth less in dollars. This creates a brutal dynamic. Expenses rise in local currency while crypto income is volatile and slumping. For many, the margin has turned negative. Smaller, less efficient miners are pushed out, consolidating mining into large-scale operations with very cheap power. To know where you stand, calculate income minus costs, including pool fees. If it's negative, you're paying to run the machine. To grasp mining economics, understand where rewards come from. Miners are compensated from two sources: block rewards and transaction fees. First, the block reward. New coins created and awarded to the winning miner or pool. That miner adds the next block to the chain. For Bitcoin, halvings cut block rewards roughly every 4 years, immediately slashing revenue by 50%. Older, less efficient hardware can be forced offline. Second, transaction fees. When the network is busy, fees rise and can become a larger slice of miner income. Profitability depends on coin price, current block reward, and network congestion. Some chains move to proof of stake, reducing profitable options for GPU miners. Hardware choice is critical: ASICs or GPUs. ASICs are ultra-efficient for a single algorithm like Bitcoin, but they are expensive, loud, hot, and single-purpose. If profitability dies, resale value is limited. GPUs are flexible, mine many algorithms, game, create, or run AI, supporting better resale and exit options. In late 2025, AI demand props up GPU resale prices. For small miners, GPUs can be a lower-risk entry because value holds and exits are simpler. Bottom line, ASICs win on efficiency for cheap power pros. GPUs win on flexibility and salvage value for small miners. A miner's survival guide for late 2025. Letting rigs run and hoping is a recipe for losing money. Option 1. Pause or turn off your rigs when daily math is negative. Stopping saves cash and buys time to reassess. Use a simple flow. Profit: 0. Join a pool. Profit: 0. Pause. Consider selling or waiting for market change. Join a reputable mining pool for steadier payouts. Fees are usually around 1%. Predictable income helps manage cash flow. Cheapest power wins, solar where feasible, or relocate to regions with low-cost hydro or geothermal. But relocation is capital and logistics heavy. Consider exits. Switch coins with GPUs or sell hardware into strong AI and gaming demand. Reallocate capital to buying crypto or yield strategies that don't burn electricity. In November 2025, the U.S. government shutdown weighs on sentiment and coin prices. Fear pushes risk assets down, often including crypto. Agencies slow roll approvals and data, indirectly impacting large-scale builds. Don't expect relief on your home electricity rate. Treat the shutdown as one variable. Stick to your numbers. If unprofitable, pause and preserve capital rather than gamble on a fast rebound. If mining math fails, you can stay in crypto without huge power bills. Staking on proof-of-stake chains lets you earn rewards by delegating to validators. Rewards are paid in the same token, returns shown as APY. It is capital-based income with minimal operational cost. Mining needs hardware and power. Staking needs only the token. The main risk is token price. You can also provide liquidity on decentralized exchanges to earn trading fees. Yields can be high, but beware impermanent loss. For ex-miners, staking and liquidity providing shift rewards from energy to capital. Different risks, different rewards. Choose the model that matches your tolerance and time frame. The key is discipline. Allocate deliberately, monitor, and avoid chasing hype. Mining remains essential because it secures Bitcoin. Bitcoin's uniqueness comes from its design, security, decentralization, scarcity, all anchored by proof-of-work mining. Supply is capped at 21 million. New Bitcoins are minted through energy-expending proof-of-work. The massive hash rate makes attacks impractical, creating trust and value. Profitability is cyclical. Lean times, then recoveries. Survivors cut costs during slumps to be ready when prices rise. The future favors efficient players with cheap energy and latest-gen ASICs. Innovation squeezes costs, reuse heat, optimize load, sell power back. For hobbyists, competing on cost is tough. Choose carefully where to play. Mining won't die. It will adapt and endure with technology and market shifts. So, where does this leave you in November 2025? You need an actionable plan for today. Markets, politics, and social media are noisy. Focus on what you control and make one calm decision from your numbers. It is simpler than it seems. Either keep losing money or protect your capital. Step 1. Do the math, right now. Use a reliable profitability calculator. Enter your exact model, hash rate, power draw, and your real electricity price from your bill. The tool will output today's daily profit or loss. Be honest. No hopeful future prices. No outdated rates. Use today's facts. If daily PL is negative, turn off the rig. It is hard after investing, but running it is burning cash. If barely profitable, join a reputable pool and monitor weekly. If it flips negative, power down. Consider selling hardware while GPU demand is strong. Reallocate into direct coin buys or staking to keep earning without energy costs. Make the decision based on your math. That is how you survive the 2025 squeeze. Here is a realistic option for November 2025 in today's conditions. If you pay around 15 cents per kilowatt hour and mine at home, pause your rig unless calculator PL is clearly positive. List GPUs at fair market price. Current AI and gaming demand can recover a meaningful share of your cost basis. Reallocate capital via dollar cost averaging into BTC and a POS asset you understand and can stake. Stake through a reputable validator with transparent fees and slashing history. Avoid custodial lockups if possible. Set rules. No leverage, weekly review of yields versus price risk, and keep an emergency cash buffer. Treat the shutdown as temporary noise. Stick to the plan unless your numbers change materially. Looking forward, Bitcoin's role as scarce, decentralized collateral remains unique. As halving shrink block rewards, a growing fee market can sustain miners, especially efficient operators with cheap power. Integration with renewables and grid services will tighten costs and align incentives. For small miners, participation shifts. Stack BTC directly, stake POS assets, or mine only where power is truly cheap. Love this build? Smash that like button and subscribe to Crypto Miners Rigs for more epic content and mining magic. Mining isn't dead, it's selective. Capital, power price, and efficiency decide who survives the squeeze. Do the math. Decide. Survive.